From Elements, ranked the U.S. banks with the most uninsured deposits, article by Dorothy Nofeld, and this lovely graphic by Sabrina Lamb. Let's take a look here. It's the top U.S. banks by uninsured deposits. Ever since the collapse of Silicon Valley Bank and of Signature Bank, there has been a renewed interest in understanding the amount of uninsured deposits. Part of the reason for Silicon Valley Bank's failure, as covered previously when we compared SVB to Schwab, link up there, was because of its Silicon Valley Bank's unique mix of clients that led it to have such a high percentage of uninsured deposits, such that when it failed, the fear was that all of those uninsured deposits would be lost, or at least a good portion of them. So diving into this graphic up top, we can see SVB here at 93.8% uninsured deposits, with Signature Bank following a few steps below it at 89.3% right here. Now then, what about these two banks in between these two failed banks, BNY Mellon and State Street Bank? Now the key difference here, or one of the key differences, is the total assets that they hold. On the right, we can see that SVB held a total asset of 209 billion and Signature Bank held an asset of 110 billion. Comparatively, BNY Mellon and State Street held 325 and 298 billion respectively. Why this is important is because of the 2010 Dodd-Frank rule, where there is a line in the sand at 250 billion, discriminating between the systemically important banks and those that are not systemically important. Because BNY Mellon and the State Street Bank are considered systemically important, they have higher stringent requirements for what kinds of assets they hold, as well as having to go through more rigorous stress testing. As you can see here in this additional portion of the graphic, BNY Mellon was second in uninsured deposits, but had low ratios of riskier debt holdings to deposits, where loans and held-to-maturity securities and deposits for BNY Mellon was just at 31%, as compared to SVB's 94% right here. So why does this matter? Part of the second reason for SVB's failure was because they held way too much held-to-maturity securities and deposits, where in conjunction with the macroeconomic factor of rising interest rates caused them to hold a lot of book losses. When all of these uninsured depositors ran to get their money, SVB was forced to realize those losses and therefore could not sustain its business. We scroll down through the article here. Here's what I want to highlight. Where these two banks, both BNY Mellon and State Street, are different from SVB is that their loans and held-to-maturity securities as a percentage of total deposits are much lower. Therefore, they hold much less book losses or paper losses, and so that even if they were in hypothetical forced to realize those losses, it would be a much more limited loss than SVB had to go through. So, why this $250 billion mark? Well, SVB and Signature Banks lobbied very hard to loosen bank rules to be exempt from the systemically important bank listings. If you scroll down here, from the Hill, in pushing for regulatory overhauls, SVB and Signature Bank argued that they weren't a systemic risk to the economy and thus should not be subject to the same rules as big banks. But when federal regulators intervened on Sunday, this was articles written a few weeks ago, when federal regulators intervened on Sunday to ensure that depositors got their money back, they cited systemic risks to the banking system. Meanwhile, shares of top regional banks plummeted on Monday amid fears that depositors could move their money to larger institutions. All right, we will be covering this last point a little bit later, but what is interesting to note here is that they avoided all of these regulations by claiming that they weren't systemically important, but then the depositors were bailed out due to systemic risks to the banking system. One might say, well, the depositors, you know, were innocent bystanders in this, and in a sense, they are correct. However, the reason that these VCs and venture capital corporations ran to SVB was because of favorable treatment there. Furthermore, if we look down here, I wonder if I can zoom in. This document is the account protection document from TD Ameritrade, where it details out how much they protect their assets. What's key here is, besides the traditional FDIC insurance for cash and SIPC insurance for securities. There is an interesting sentence here. Additionally, TD Ameritrade provides each client $149.5 million worth of protection for securities and $2 million of protection for cash through supplemental coverage provided by London insurers. In other words, TD Ameritrade believed it was important enough to purchase additional insurance to cover their account holders, meaning that even without FDIC, if SVB and Signature Bank and all of these other banks thought it important enough to insure deposits, they could always go out into the marketplace and purchase insurance for themselves. It is also interesting to note here that TD, although they have purchased additional coverage, the TD Ameritrade supplemental coverage has an aggregate limit of just 500 million over all their customers. So, in the event of a fire sale such as Signature Bank or Silicon Valley Bank, the coverage only would go over 500 million, which is a fraction of, say, the 209 billion. What this means is that this insurance is very expensive, and therefore expecting the federal government to foot the bill for this massive insurance claim might be a bit much. The last important point I wanted to cover here is that shares of top regional banks plummeted on Monday amid fears that depositors could move their money to larger institutions. What does this mean? Well, because smaller banks are not considered systemically important, while larger corporations and banks are, the FDIC has coverage to insure all of the deposits over that $250,000 FDIC limit, meaning for those people who bank with smaller banks that are not systemically important banks, their deposits over 250K are not insured. However, if they move those assets over to systemically important banks, then FDIC does have leverage to cover them. This is one of the reasons why, from US News, US FDIC may need temporary guarantee for all bank deposits from the ex-chief there. And as they claim, because of this risk for a switch and outflow of assets from these smaller regional banks to these larger banks, the risk is that these larger banks would only get greater and bigger and thus reduce competition among the marketplace. As we can see here from the Spider S&P Bank ETF, since March 8th, it has taken that plummet due to the SVB news. However, the other two banks that we had covered previously, BNY Mellon and State Street, we can see that while yes, they did take a hit on March 8th, here and here, it is nowhere near the jump down that the rest of the banking sector had experienced. So as we can see, part of the fears of certain analysts are correct, that regional banks are taking the brunt of it while the bigger banks are not. Then the question still remains, who should foot the bill for coverage of all the deposits over that 250,000? In any case, hope this was helpful, and as always, for any investments dividends related, check out Div Income, available on Android and iOS.